This is the Financial Sense News Hour with the president of PFS Group, Jim Poplava. Since 1982, PFS Group has offered asset management and educational resources that have helped investors build, maintain, and preserve their wealth. Now, here's the Financial Sense News team, Jim Poplava and John Leffler.
The international monetary system has collapsed 3 times in the past 100 years, in 1914, 1939, and 1971. Each collapse was followed by a period of turmoil, war, civil unrest, or significant damage to the stability of the global economy. The next financial collapse will resemble nothing we've seen in history. Deciding upon the best course to follow will require comprehending a minefield of risk while poised at the crossroads pondering the death of the dollar. Joining me on the program as my special guest is Jim Rickards. He's the author of a new book called The Death of Money, The Coming Collapse of the International Monetary System. And Jim, in your book, you talk about the demise of the dollar and by extension, the potential collapse of the international monetary system, because if confidence in the dollar is lost, and this is a very key point, no other currency stands ready to take its place as the world's reserve currency because the dollar is the linchpin. If it fails, with it is the failure of the entire system. Let's talk about that.
Thank you, Jim. Yeah, as you mentioned in the introduction, the title of the book is The Death of Money, The Coming Collapse of the International Monetary System. And when I say that, it sounds provocative, but it's really not meant to be. As you correctly explained, the system has collapsed 3 times in the past 100 years. The last time was in 1971, a little over 40 years ago. So these things do happen every 30 or 40 years. Now, it doesn't mean that, it's going to happen tomorrow like clockwork, but I would expect this sooner than later for some reasons that I explain in the book. But the important thing is when the system collapses, it doesn't mean the end of the world. It doesn't mean that we all go live in caves and eat canned goods. What it means is that the major financial and trading powers sit down around the table and they rewrite what they call the rules of the game. And the rules of the game is not my expression. That phrase has been around for 100 years. It's the way experts describe the workings of the international monetary system. So what I do in the book is, first of all, explain things that are visible today, the dynamics that are leading to the collapse, but then go further and say, okay, when the collapse comes, what will the new rules of the game be? What will the new system look like? And what can investors do today to prepare for that so they can preserve wealth through not only the collapse, but into the new system as well. So, it's got some history, it's got some economics, it's got some national security aspects to it, it's got some, kind of forward forecasts, so I hope the readers enjoy it.
Something that has happened since 2009 that surprised a lot of people, which you address in your book, with the amount of quantitative easing going on both here, Europe, UK, and Japan, the dog that didn't bark was inflation. Explain that.
Well, there are 2 very specific reasons for that. First of all, conventionally, this goes back to Milton Friedman, and a lot of other people have said the same thing. When you print a lot of money, you're going to have more money chasing the same amount of goods, and that's going to cause prices to go up. And that's kind of conventional, what's called the quantity theory of money. Well, you look at the Fed's balance sheet. You can go to some sources and see it on a graph. It looks like a Roman candle. It kind of goes along for a very long period, from 1975 to 2009. Now, it certainly increases. Money supply is going up, but it's going up at a nice, steady slope, exactly what Milton Friedman would have recommended. And all of a sudden, in 2009, it goes vertical, like a Roman candle, then it's sideways a little bit. That was QE1. QE2 is another leg up, then it goes sideways again, and then QE3. You can see QE1, 2, and 3. So the money supply has gone from $800 billion to over $4 trillion in the last 5 years. And so where's the inflation? Where's the 300% inflation that you would have expected? Well, 2 things happened. One was a lot of our potential inflation got exported abroad to other countries, and that's what my first book, The Currency Wars, was all about. Just to give a very simple example, let's say you're China and you don't want your currency to go up. You want to keep your currency down because you're trying to promote exports. So you peg to the dollar. Well, when you peg your currency to the dollar, in effect, you've outsourced your monetary policy to the Fed, because the Fed prints money. So what happens to the dollars? Well, they find their way to China in the form of a trade surplus or direct foreign investment. So the dollars show up in China. The People's Bank of China says to Chinese manufacturers, hey, you have to give us your dollars at a fixed exchange rate because we want to maintain the peg. So we'll give you yuan, their local currency, in exchange for the dollars. If they don't steal the dollars, they give them local currency in exchange for it. So that means as the Fed is printing faster and faster, the People's Bank of China is printing faster and faster. In fact, the People's Bank of China has actually created more money than the Fed in the last 5 years, if you can believe that. So the point is, we didn't get the inflation here. It was exported abroad. It did show up in China. It showed up in Brazil. It showed up in the Arab Spring. That was one of the contributors to the riots we saw in 2011 and so forth. But it's just a matter of time before those other central banks throw in the towel, let their currencies go up, which is what Bernanke told them to do, and then that inflation comes back to the United States. So that's one thing you can see coming. The other reason is that the increase in nominal GDP has two parts. It's like a ham and cheese sandwich, right? You need the ham and the cheese. The money supply is the ham, but the cheese is what's called velocity or the turnover of money. And this is the failure of Bernanke's, helicopter money theory. He said, well, I never worry about causing inflation. I know I can do it because I can just push money out of helicopters, print it and push it out of helicopters. But what if people just left it lying on the ground? In other words, picking up the money involves going into debt. And people don't want to go into debt. They want to sell assets, get cash, pay off debt, deleverage their balance sheet. They don't want to go into debt. And so even the printing money doesn't work if people don't want to spend it, and that's what's been going on. So the combination of exporting some of the inflation abroad and the declining velocity or turnover of money have meant that they can print all they want, and you still don't get the inflation. But here's where it breaks down. Janet Yellen is determined to get the inflation. Central banks have to get inflation. They cannot tolerate deflation. So they print and they print and they print, and they're still not getting the inflation. Guess what they're going to do? They're going to keep printing. And they're going to say, well, eventually we're going to wear you down. We're going to get that inflation. And my thesis is that you might get that inflation, but you might cause a collapse of confidence in the meantime. On the way to printing so much money to get the inflation, you might actually destroy confidence, and then that's when you have this kind of catastrophic collapse. So we're only halfway through this movie. We got to see the rest of it yet, but it's going to end badly.
Yeah, something I think many Americans aren't aware of is that the Fed's objective is, as you just mentioned, higher inflation as an answer to the debt crisis. And a lot of the alternative methods of identifying inflation show much higher inflation rates than what is widely reported. But talk about, Jim, the objective and why they want inflation as it relates to debt, because I think most Americans don't understand that, because you always hear talk about the dual mandates, stability, keeping inflation under control, when their objective is to actually create inflation. In fact, they've even gone so far this time as to say they want to create it.
Well, that's exactly right, Jim. That's very hard for people to get their minds around, because you go back to 1980, inflation was out of control. I mean, from 1977 to 1981, that 5-year period, cumulative inflation in the United States was 50%, 50. The dollar lost half its purchasing power in just 5 years. I mean, people go back to 1913 and say it's lost a lot of purchasing power since the creation of the Fed. That's true, but there you had a 5-year period where it lost half its purchasing power. So if you had an insurance policy, an annuity, retirement income, savings in the bank, you lost half your money in terms of the real value of the money. So Paul Volcker comes along. The combination of Paul Volcker and Ronald Reagan did get the inflation under control. It was painful, but eventually they did. And the economy grew very well in the 1980s and 1990s. So you had this 30-year period where from about 1980 to 2010, where the reputation of the Fed was as an inflation fighter, and an entire generation grew up understanding that. So the idea that the Fed actually wants inflation after they spent 30 years fighting inflation and actually winning is very hard for people to understand. But now they do want inflation. Here's why. Because going back to what we said earlier, printing money doesn't do you any good unless you can get the turnover, get the lending and spending going. That's, like I say, that's the cheese and the ham and cheese sandwich. So how do you do that? Well, you need two things. You need what are called negative real rates. A negative real rate is when inflation is higher than the nominal rate. So take a 10-year Treasury note. Right now it's about 2.7%. And people say, well, interest rates are close to all-time lows. Well, nominal rates are close to all-time lows, but real rates are very high because inflation is only about 1%. So if you have 2.7% on the 10-year note and 1% inflation, your real rate is 1.7%, which is quite high. So what the Fed has to do, they've got to get inflation up to kind of 3.5. They won't talk about this publicly. I actually have heard Charlie Evans, the president of the Chicago Fed, mention it publicly, but you don't hear it in any of the speeches. They want to get inflation up to like 3.5, and then use financial repression or bond purchases, money printing, in effect, to keep the nominal rate maybe around, somewhere between 2.5 and 3. Now you have a negative real rate. Inflation is higher than the rate of interest. That's a very powerful inducement to borrow. When you borrow in a negative real rate environment, the bank is actually paying you to be a borrower because you get to pay them back in cheaper dollars. The second thing the Fed needs to do is to deliver an inflationary shock. So they always say they have a 2% goal, a 2% inflation goal, 2% ad nauseum. Well, if I promise you 2% and I give you 2%, there's no change in your behavior because you got exactly what you expected. What the Fed has to do is lie to you. They have to promise you 2% and give you 3%. Then it's a shock. You're like, oh my goodness, inflation is out of control. I better go buy a house, buy a car, buy a refrigerator, whatever it is. So by getting inflation up to 3.5%, and keeping nominal rates low with financial repression, they get two things. They get negative real rates, which is a powerful inducement to borrow, and they get an inflationary shock, which is a powerful inducement to spend. And the combination gets the lending and spending machine going again, gets the velocity going, gets nominal GDP back to trend. At that point, they can make it self-sustaining, withdraw policy, substitute real GDP for nominal GDP, get real GDP back to trend, and we all live happily ever after. That's what the Fed's trying to do. They will fail. They will fail for a number of reasons. But right now, look at what, they're trying to get the inflation. The problem is, the scary part for them is they can't get it. They've had 15 separate policies since 2009. They've had, QE1, QE2, QE3, Operation Twist, forward guidance, currency wars, nominal GDP targeting. They had a 6.5% unemployment goal, then they threw it away. They're just improvising, making it up as they go along. They've tried everything and it hasn't worked. So it's a very dangerous, scary world from the Fed's perspective. They need the inflation. They're not getting it. They're trying everything. They're going to keep trying, and they're going to end up destroying the dollar.
In your book, you talk about these threats to the dollar. One of them, which I want to get into shortly here, is financial warfare. That's probably a new term to a lot of our listeners. You talk about deflation and then hyperinflation, or maybe a market collapse. So let's get into financial warfare, because I want to get into something that happened after 9/11, Jim. And that was the government noticed that there was large option selling activity in the airline stocks prior to the event of 9/11. And we've known in the financial world for decades, insider trading cases show options are the insider trader's tool of choice. So let's talk about the 9/11 Commission, which failed to conclude that terrorist insider trading took place, and it's really due to its failure to understand signal amplification. Explain that term and how it applies to financial warfare and also insider trading.
Sure. Let's start a little bit with financial warfare, and then I'll come around to come back to the insider trading. And I do discuss that in Chapter 1 and Chapter 2 of my book. Financial warfare is different from a currency war. A currency war is a struggle, but it's actually an economic struggle, and we've seen them before. So countries are trying to cheapen their currency to, import inflation and promote exports, and it doesn't work because I cheapen my currency, and then you retaliate by cheapening your currency, and we just go back and forth. That's a currency war. Financial war is different. Financial war is not really economic. It's really military and geopolitical. I try to damage your economy. I try to hurt you using financial weapons. And we talked about this in my first book, Currency Wars. We had a financial war game run by the Pentagon, the top secret weapons laboratory, in 2009, right outside of Washington. I was on the game design team, and I also got to play the game. And that was theoretical. That was a war game exercise. But we did lay it out in 2009 as to what could happen. Now, we had a scenario then where Russia and China pool their gold resources, issue a new currency, turn their back on the dollar, and invite other countries to join into this new system. We were absolutely laughed at by, the Harvard types and the eggheads. They said, that's ridiculous. You're wasting our time. Don't you know that gold's not part of the international monetary system? But we went ahead and pursued it anyway. Well, here we are 5 years later. What's happened in the last 5 years? Russia has increased its gold reserves 70%. China has increased its gold reserves several 100%. No one knows the exact number because they're not transparent, but we have enough information from mining and import figures to know that they've increased it 2 or 3 times. So the Chinese and Russians are actually behaving exactly the way we warned the Pentagon they might back in 2009. Now, coming forward and coming into the new book, The Death of Money, we've actually been in a financial war with Iran since 2012. We kicked them out of the dollar payment system. We got our allies to kick them out of the international payment system. When we kicked Iran out of the dollar payment system, they said, who cares? We'll just price the oil in euros. Well, then we kicked them out of the international payment system, so they couldn't get euros either. So now, they could ship their oil, but they couldn't get paid for it, at least not in the currency anyone wanted. So they were doing workarounds, and then people in Iran were taking the money out of the bank, going to the black market, trying to get dollars to get imports. That was causing a run on the bank. They had to raise interest rates to stop the run on the bank. Inflation got out of control. We were well along the path to destroying the Iranian economy, which might have led to some kind of peaceful regime change without any U.S. military action. That was a real cutthroat financial war, although in December the president called a truce, in effect, took the sanctions off Iran and released tens of billions of dollars to them. So that's financial war. We're in the beginning of another financial war with Russia right now over Crimea. Of course, they invaded Crimea. It's now Russian territory. If you go to an ATM machine in Crimea, which, technically is part of Ukraine, you get rubles. Rubles are coming out of the ATM machine. They've already converted the currency. Now, nobody, left, right, or center, thinks that there should be a military response. Nobody thinks that we should, send the 82nd Airborne into Crimea. But the U.S. doesn't want to do nothing, and so what we're doing is economic sanctions, which is a form of financial warfare. But unlike Iran and some other countries we pushed around, Russia is in a position to retaliate. Our sanctions are toothless. They're very, very tame. A couple oligarchs won't get to go to the Super Bowl. That's about it. If we were to do something serious, like try to freeze Putin's personal assets or kick, their biggest banks, Sberbank and Vneshtorg Bank, out of the payment system, they would shoot back. They would dump U.S. treasuries, and they've already said this. They've said this publicly. That would drive up U.S. interest rates, sink our housing market, sink our stock market. They could refuse to pay U.S. dollar debt. They could freeze U.S. assets in Russia, et cetera. There's a lot they could do to fight back, and therefore the U.S. won't escalate to begin with because of Russia's ability to fight back. So that's kind of mutual assured financial destruction.
Let me stop you there because the president has been criticized why he hasn't done anything. What you're telling me right there, one of the reasons the U.S. has not been able to move as aggressive as we have in the past is we are somewhat limited because of the financial threats they pose.
That's exactly right. It's exactly like the Cold War. We had enough missiles to destroy, it was the Soviet Union at the time, but basically Russia. We had enough missiles to destroy Russia. They had enough missiles to destroy us. So that was an unstable system because there was always the temptation to shoot first. Like, hey, if I shoot my missiles, I'll wipe out the other guy and I win. So this started the arms race where the country said, well, I'm going to build more missiles, so even if you shoot me and cause a lot of damage, I can shoot back in what was called the second strike. And it was like we used to call it two scorpions in a bottle. One scorpion can sting the other and kill it, but before the victim dies, it has just enough strength left to sting back, and then they both die. That was called mutual assured destruction, or the MAD doctrine. And it actually was stable. It kept the peace, even though it was a very scary state of affairs. Now, come forward 45 years. We now have mutual assured financial destruction. You're exactly right. The U.S. will not impose harsh sanctions. They will be toothless because Russia can escalate and fight back. And at the ultimate, they could unleash their hackers and close the New York Stock Exchange. When I say this, people go, oh, that would never happen. And my answer is, well, what happened on August 22nd, 2013? The NASDAQ was closed for half a day. We've never had an explanation as to what happened there. Was it Iranian hackers, Syrian hackers, Russian hackers who were practicing? If it was technical, why haven't they told us? And if it was foreign hackers, you can understand why they haven't told us. And beyond that, someone else said, oh, well, we have good hackers. We can close the Moscow Stock Exchange. And my answer was, yeah, great. They shut down New York. We shut down Moscow. Moscow's spare change. And Moscow's a joke. Who loses? Who wins? The Russians win because we have a lot more to lose. So because Russia has the capacity to fight back in financial warfare, we're not going to escalate because we'll lose more than they will. So that explains that. So that's what financial war is. It's going on all around us. It's going on in Iran. It's going on in Russia. You'll see it elsewhere. And I have a whole chapter on this in my book. Now, Jim, to get specifically to your question about 9/11, there was insider trading ahead of 9/11. It's very apparent. I talked about this in Chapter 1 of my book, The Death of Money. There's statistical evidence, there's forensic evidence, there's anecdotal evidence, etc. In other words, the terrorist associates knew the attack was coming. Not a lot of people knew, but some people knew. And in the last several trading days prior to the attack, there was massive buying of put options in United Airlines and American Airlines. So United and American with the two airlines that were hijacked on 9/11. Of course, buying a put option is a bet that the stock's going to go down, and it did go down. It went down 45% after the attack. So those traders were in a position to make a lot of money. Now, the signal amplification has to do with the fact that when the terrorist trades were done, they were probably very small. There's a few thousand shares because, say you're a safe house operator, you got a couple $1,000s in an E-Trade account. You're not going to buy puts on 1 million shares. But somebody notices that. It could be a specialist, could be someone watching the tape, an upstairs trader like a hedge fund, and they say, the market's up, the sector's up, but people are buying puts on this one airline. They know something I don't, so they'll go out and buy puts themselves. Now, the second guy is not a terrorist. He's not even an insider trader, but he sees something and he piggybacks on the trade. Well, that makes it bigger. Somebody sees that, they piggyback too, et cetera. By the end of the day, you could have 1 million shares changing hands, even though only the first couple thousand were actually criminals. That's what we mean by signal amplification. When the 9/11 Commission studied this, by the way, they never said that there wasn't insider trading. What they actually said was that they didn't find any evidence of it. Well, if you don't look in the right place, you're not going to find the evidence. In other words, it was sort of a lawyer's dodge, like a backhanded conclusion. And the fact that they didn't see it doesn't mean it didn't happen. And there's lots of evidence indicating that it did happen. They just didn't look at that particular evidence. So I got involved with the Central Intelligence Agency after 9/11. The CIA wasn't really drilling down into what happened before 9/11. That was left to the 9/11 Commission and the SEC. But what they said is, well, wait a second. If that did happen and there was another terrorist attack coming, could there be more insider trading? Could you see it? Could you track it to the source, get a warrant, break down the door, and stop the attack and save thousands of lives? That was the strategic study I was involved in, and we modeled terrorist trading. We did a lot of research. It's all described in Chapter 1 of the book, but the idea was use market information to discern the activities of market participants and get advanced knowledge of an attack. That then branched out into a whole new field of what we call MarkInt, or market intelligence, where you could use it for things other than terror. We did a counter-terrorist project, but you could see Venezuela, dumping treasuries to buy gold. You could see Iran doing the same thing. There are a lot of things around the world you can see if you use market information. So we have financial warfare, market intelligence, insider trading ahead of 9/11. It's all discussed in my book, The Death of Money.
Jim, let me ask you this. As you began to model this and you could spot this activity, you were given this information to the CIA, but you were also given information to the SEC because you were seeing this suspicious activity that would imply insider trading. And then it sort of got into, I wouldn't describe it a turf war, but it's like, oh, well, really, that's not our jurisdiction. We don't get involved in that. But the thing that really struck me is your models showed that you could actually spot this activity. The naivete of the Fed and the Treasury are like, well, yeah, that's sort of there, but we really don't pay much attention because nobody would try to do that to us. That's what really struck me.
Well, it struck me too, and I spent years not only working on this project, but meeting with the Treasury and the Fed, and National Counterterrorism Center, the FBI, Homeland Security, Pentagon. I mean, we really made the rounds for years trying to, kind of like Paul Revere trying to sound this warning. Now, here's the thing. We built a signal engine to look for terrorist insider trading, but we kept finding what I call regular insider trading. In other words, we were seeing insider trading. It wasn't terrorists. It was crooks. So we were giving referrals over to the SEC because, CIA is not a law enforcement agency. We weren't spying on anyone. We were using open source information that anybody can get just by, having a Bloomberg terminal or buying a data feed from Thomson Reuters or Dow Jones or anyone else and having some good computer algorithms. So we were seeing it, but we were seeing like kind of ordinary crooks. We did find one terror incident, which I talked about in the book. That was the August 2006 terrorist effort to blow up planes using liquids on board. That's the reason you can't take a mouthwash on a plane anymore because of that. But I talked about that in the book. But yeah, that's exactly right. Now the problem is that so the CIA got a little antsy because they said, this looks a little too close to domestic law enforcement, which they don't do, and that's right. They shouldn't be doing that, even though we were using open source. So we took it over to the Pentagon. That's all discussed in the book. But when you talk to people at the Fed and the Treasury, they say, the Chinese would never dump Treasury securities because it would cost them money. Well, of course it would cost them money, but since when do you go into a warfare without spending money? The point being, if you want to damage the United States, you can do it. What's the point of a war? Well, the point of a war is to damage the enemy economically so they surrender. Well, why do you need to shoot anything? You can just do it with financial instruments, covert hedge funds, various kinds of economic strategies and accomplish the same result. And it might cost you some money, but it costs money to build an aircraft carrier. It costs money to keep a standing army. So the objection that it would cost money is ridiculous because it's not a wealth maximizing exercise. It's a power maximizing exercise. You see that in Crimea today. Everyone says, Putin will have to back off because we're going to impose economic sanctions. He doesn't care. He could care less. He's got Crimea, and he'll probably have eastern Ukraine before long. The point is, the fact that you're imposing costs on him doesn't matter. How many, 50 million Russians got killed in World War II, one way or the other. There are always costs in war, but he's winning on the ground, and that's what matters to him.
I want to talk about something you address in your book, and that is, we got a bit of a shock at this. I think it was in 2009 where China is stockpiling gold, and you believe their gold reserves are understated. And one of the lessons you talk about that was learned with the financial Asian crisis that took place in 97 is when Western bankers pulled out money suddenly out of markets, they could collapse along with the currency. In fact, Jim, we saw a little bit of that in January in the emerging markets.
Correct.
But China and many of these countries walked away and say, you know what, we don't want to be put in that position again. So China began to build up significant gold reserves, which they continue to do this day.
Correct. Now, China started with paper reserves, and these are what the IMF calls precautionary savings. You build up, reserve positions just like your savings account. So, if you make $100,000 and you spend $80,000 on, everything you do, rent, mortgage, and everything, and you have $20,000 left over, and you put that in a savings account or maybe invest in the stock market, those are your savings. Well, countries have the same thing. When a country, exports more than they import and they earn a surplus, those are their reserves. That's what reserves are. Well, you have to invest them. You have to put them somewhere. You can't put them under your bed. So China was buying U.S. Treasury debt. But, Jim, I'm sure you know the oldest joke in banking is if I owe you $1 million, I have a problem. But if I owe you $1 billion, you have a problem because you have to collect $1 billion from me and I can walk away. Well, China started out feeling good. Like, hey, we got all these reserves. We're making all this money. We're buying all these treasury bonds. And then one day they woke up and said, wait a second. The United States owes us $3 trillion. We have a problem. We, the Chinese. Everyone thinks the U.S. is in trouble because we owe the Chinese so much money. We're not. We can just print it and hand it to them. We can say, hey, here's your $1 trillion. Good luck buying a loaf of bread. And that's what the U.S. has always done, is resorted to inflation. So the Chinese have a problem. So they said, okay, we can't dump these treasury bills. We can't. The market's big, but it's not that big. And it would be extremely costly to do so. And so what we'll do instead, we'll acquire gold by the thousands of tons. And again, a lot of your listeners are very familiar with the gold market. There are only about 35,000 tons of official gold in the world. I'm not counting private gold. I'm just talking about official gold. So when a country goes out to buy 3,000 or 4,000 tons, which the Chinese have done, that's 10% of all the official gold in the world. It's an enormous amount of gold. Well, that's what they've done, and they've built up this big. No one knows the exact number. I have some estimates in the book, and I give the backup for the estimates so the readers can judge for themselves. But no one knows the exact number. But 4,000 tons might be a pretty reasonable estimate at this stage. And China's sitting there saying, fine, we, the Chinese, want a strong dollar. Believe it or not, they're the dollar's best friend because they have so many dollar-denominated securities, really trillions of dollars worth. We want a strong dollar. But if you, the United States, cheapen the dollar through inflation and money printing, we're going to lose on our paper, but we're going to make it up on our gold. In other words, in a world of inflation, gold, we all know what gold's going to do. It's going to double and then ultimately triple. So what they've done is they've built a hedge position. If the dollar is stable, they might not make much on the gold, but their dollars will be valuable. But if we inflate the dollar and diminish the value of their savings, they'll lose on the paper, but they'll make it up on the gold. So a lot of people speculate that China's trying to buy the gold to come out with a gold-backed currency. That's not going to happen anytime soon. China's not even close to having the reserve currency. What they are doing is building a hedge position to preserve their wealth. And what I say to investors is, hey, if it's good enough for the Chinese, it's good enough for the rest of us. In other words, we should have some gold, not all in, but kind of 10% gold, so to hedge all of your other assets. So if it's all good, that's fine. Maybe the gold goes sideways. But if everything else collapses, your gold will be skyrocketing and you'll preserve wealth.
Jim, you talk in your book about financial warfare as part of asymmetric warfare, that we're likely to see more of that as we are today, in addition to, let's say, currency war. Why, with financial innovation, which was invented in the U.S., why are the Chinese so ahead of us in strategic financial warfare? You talk about hedge fund sleeper cells, and also the difference between a financial warrior who's not looking for profit. He's looking to create chaos. How did they move ahead of us when the innovation in the world of finance, from derivatives to everything else, securitization, took place in the U.S.?
Well, Jim, the old saying, necessity is the mother of invention. In conventional warfare, meaning, missiles and submarines and aircraft carriers and lasers and drones and all the other stuff, nobody comes close to the United States. There's not a military in the world that can stand up to the United States. We can sink any navy, suppress any air force, disrupt any command and control system in the world. So if you're China or Russia and you think you might have to confront the United States in various ways, and you know that the U.S. has a superior military, you're going to look for other playing fields where you can confront us with a much more level playing field. What would those be? Well, it would be cyber, chemical, biological, radiological, and financial weapons. In other words, what we call asymmetric or unrestricted warfare. You don't want to fight the United States in an arena where the U.S. will always win. You want to fight the arena in a place where it's much more of a, as I say, evenly matched. And cyberspace is a good example. The U.S. has great hackers and great cyber capabilities, absolutely, but so do the Chinese and the Russians and many others. So you're going to pick your fight and make sure it's one that you can win. So they've gone to financial warfare and cyber warfare because that's an area where they can win. And again, I think the confrontation between Russia and the U.S. over Ukraine is a good example. Even if you don't win, at least you can fight the U.S. to a tie or a standstill. I mean, what if China invaded Taiwan? And the U.S. said, hey, we're sending the 7th Fleet. We're going to interdict the Taiwan Straits. We're going to stop your fleet, et cetera. And the Chinese say, fine, we'll close the New York Stock Exchange tomorrow with our hackers. And you're the president. What do? You might just leave Taiwan to its fate because you don't want to destroy the U.S. economy. And that's an example of how these cyber financial threats, maybe we can talk a little bit more about this in our next interview. These threats converge and create a much more level playing field between, say, China and the United States.
And that is something that unfortunately we're going to have to stop right now. I know your time is restricted, but we will take this up in part 2, The Death of Money, the Coming Collapse of the International Monetary System. Jim Rickards' new book. He was also the author of the best-selling book, Currency Wars. Jim, thanks for your time, and I look forward to doing that part 2 as we get into more depth of this book, which is just very well written, by the way.
Thank you, Jim.
You're listening to the Financial Sense News Hour at financialsense.com.
I feel so good come payday.
This is the Financial Sense News Hour with the president of PFS Group, Jim Poplava. Since 1982, PFS Group has offered asset management and educational resources that have helped investors build, maintain, and preserve their wealth. Now, here's the Financial Sense News team, Jim Poplava and John Leffler.
The international monetary system has collapsed 3 times in the past 100 years, in 1914, 1939, and 1971. Each collapse was followed by a period of turmoil, war, civil unrest, or significant damage to the stability of the global economy. The next financial collapse will resemble nothing we've seen in history. Deciding upon the best course to follow will require comprehending a minefield of risk while poised at the crossroads pondering the death of the dollar. Joining me on the program as my special guest is Jim Rickards. He's the author of a new book called The Death of Money, The Coming Collapse of the International Monetary System. And Jim, in your book, you talk about the demise of the dollar and by extension, the potential collapse of the international monetary system, because if confidence in the dollar is lost, and this is a very key point, no other currency stands ready to take its place as the world's reserve currency because the dollar is the linchpin. If it fails, with it is the failure of the entire system. Let's talk about that.
Thank you, Jim. Yeah, as you mentioned in the introduction, the title of the book is The Death of Money, the Coming Collapse of the International Monetary System. And when I say that, it sounds provocative, but it's really not meant to be. As you correctly explained, the system has collapsed 3 times in the past 100 years. The last time was in 1971, a little over 40 years ago. So these things do happen every 30 or 40 years. Now, it doesn't mean that, it's going to happen tomorrow like clockwork, but I would expect this sooner than later for some reasons that I explain in the book. But the important thing is when the system collapses, it doesn't mean the end of the world. It doesn't mean that we all go live in caves and eat canned goods. What it means is that the major financial and trading powers sit down around the table and they rewrite what they call the rules of the game. And the rules of the game is not my expression. That phrase has been around for 100 years. It's the way experts describe the workings of the international monetary system. So what I do in the book is, first of all, explain things that are visible today, the dynamics that are leading to the collapse, but then go further and say, okay, when the collapse comes, what will the new rules of the game be? What will the new system look like? And what can investors do today to prepare for that so they can preserve wealth through not only the collapse, but into the new system as well? So, it's got some history, it's got some economics, it's got some national security aspects to it. It's got some, kind of forward forecasts, so I hope the readers enjoy it.
Something that has happened since 2009 that surprised a lot of people, which you address in your book, with the amount of quantitative easing going on both here, Europe, UK, and Japan,